Hi everyone, this is Jason Birak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 20 years of experience in the oil and gas industry, and he's president of the Energy Prospectus Group, which researches oil and gas companies for investors. Dan Steffens, thank you for joining me again.
Yeah, glad to be here, Jason.
Now, Dan, I want to ask you about President Trump first. He's talked a lot on the campaign trail about positive legislation for oil and energy companies. Have you noticed anything specifically in the first six weeks of office where he's done positive things just for the oil and gas industry yet?
No, not really. I mean, there's a lot of talk about lowering taxes and everything. I think they're focused first on, repealing Obamacare, which would have just minimal impact on the energy industry because especially the upstream energy industry that I cover, it's not really that labor intensive, so it's not like their reporting requirements are that significant for their labor force. But if they do come through with these, backing off on some regulations, that should help. The upstream companies and all the energy industry companies pay a lot of taxes, especially sales use tax, property taxes, and income taxes. And especially the upstream, they have a lot of deferred tax liability because they cover their current tax liability with being able to deduct drilling costs and stuff like that. So they have huge deferred tax liability. So if you lower the tax rate in the future years, they will have a big decline in their deferred tax liability, which will shore up their balance sheet ratios, and should make them look more attractive to Wall Street investors and stuff. So.
Well, I want to transition now to the current crude oil price. We're at WTI around $50 a barrel. Brent crude's around 53. What type of margins are companies that operate in the U.S. like EOG and Pioneer, some of the larger independents, what type of margins are they making right now at those crude prices?
Well, in the really sweet spots like the Permian Basin, Scoop and Stack over in Oklahoma, at $50 oil, they're still making 40-50% rate of return, well-level economics, and they're doing quite well. Now you look at the Bakken, that's probably not marginal at best at $50 oil because their net back price, when you deduct the transportation cost and everything to what they actually get at the wellhead, it's much lower than what you see on NYMEX. So that's probably not very good up there, but that's why Wall Street's in love with the Permian, just because the well-level economics are so much better out there. So they're doing fine. I mean, that's why the Permian Basin companies have just done so well this year.
Now, do you think the Permian's always been lower cost, or do you think that the operators onshore and the oil service companies with these technology innovations with horizontal drilling and hydraulic fracturing, some of the other, I'm seeing drilling rigs are being automated now with these octopus pads, less humans on it. Do you think those things are responsible then for the cost coming down so quickly?
Yeah, one thing about these pullbacks, it gets the companies out of this frenzy of drill, and they can concentrate on cost savings more. And they work with the really good drilling companies like Helmerich and Payne, Patterson, and they've worked out better ways to complete these wells. And Halliburton engineers and stuff, they've figured out better way to complete the wells. They're using a lot more frac sand per well, doing more frac stages, more frac intensity per well, and they're getting much better results. I mean, the well cost have come down like 30 or 40%. Yes, they will give some of that back because the oilfield service companies, as things tighten up, will start raising their prices again. But I think the efficiencies that they've gained and the well results they've improved on will remain. So that's what's really helping them out right now.
Now, we have the oil price. It was quite a bit higher when we were supposed to do an interview last week. It's already fallen quite a bit. It's kind of in a downtrend now. Do you think this is being fundamentally driven, or is this more about the technical chart traders? Do you think there's, in other words, do you think there's a supply glut in oil or gasoline storage right now?
No, people overreact to the U.S. storage report. I mean, lots of times when you look into the details, it's just they unloaded more ships last week or something. So, I mean, if all you do is move oil from floating storage to onshore storage, I don't call that a glut. What happens from week to week in U.S. storage is not really a reflection of what's going on in production. It isn't like, production in the U.S. just instantly went up 1 million barrels a day. I mean, it's creeping up, but nothing compared to justify that. And then this is also the time of the year when inventories always build. I mean, if you look at any, crude oil inventory chart, the first quarter is when they build inventories because they're doing a lot of plant maintenance, refinery maintenance, what they call turnarounds this time of the year. And then after that, they come out, and in April, they start producing summer blend gasoline. Well, summer blend gasoline uses a lot more black oil, crude oil, than winter blend gasolines. In the winter, they can blend more things like butane in with the gasoline, but in the summer you can't because those NGLs make it evaporate easier, and so they have to use more crude oil. So you will see crude oil inventories come down. I mean, they always build in the first quarter. They always decline in the second quarter. You can just track it year after year after year if you want to go see that. But the demand in the summer for refined products also goes up about 1.5 million barrels a day. If you look at the IEA oil market report, you can clearly see that on the graphs, and they show like the last 5 years. In the third quarter, you always get a big jump in demand.
Would you say that OPEC and Russia and the Saudi Arabias have kept their word regarding production cuts so far?
Yeah. Actually, they're very much in compliance. And one thing people don't need to understand is first of all, they ramped up production in the fourth quarter as they were kind of positioning themselves for this cut that went into effect January 1st. So that oil is what it takes about 6 to 8 weeks for oil that's produced in the Middle East to show up in the U.S. It's just one of the destinations. But, it's not like oil comes out of the ground one day in Saudi Arabia and the next day it's at Cushing, Oklahoma. That doesn't happen. So there's a big time lag, and people forget about that. So and then we're probably 3 or 4 weeks away from really seeing the impact of OPEC production cuts in inventories. And remember, the U.S. is just one place where you have inventories. And if I'm a refiner, isn't this a good time to build inventories? If you think oil prices are going to be higher in the summer than they are now, why would you not build up lower cost inventory as fast as you could so you'll take more deliveries? And there's some thought that a lot of this oil's been floating around out in the ocean for a while on ships, waiting for the price to come up so it could unload. So you get some of that. I think today's reaction in the futures market, and this is not the physical market, this is the futures market, because the price you see in the news every day is the front month NYMEX futures contract. And there were so many speculators that had gone long on oil. I'm sure they were setting their stop loss orders close, and you'll kind of get a waterfall once it breaks through some resistance, which there was this really strong resistance at 52, and when it broke through that, you probably triggered a whole bunch of selling, just automated selling, and I'm sure that's what caused the $3 dip today. So, we'll see. Maybe it'll hang around here, but I've been saying for months in my weekly podcast that oil's going to flop around in the low 50s through the first quarter, and then we should start seeing it ramp up in the second quarter.
That's interesting. When I look at some of the news stories coming out in the oil market for the last few months, it seems to me oil is going to be range bound for a couple years. But then today I was on oilprice.com researching this interview, and I also saw that the IEA has said that the huge oil price spike is inevitable because of the capex cuts, the drastic amount of capex cuts for exploration and bringing new oil projects online that have been done the last 3 years.
Yeah, actually 2 weeks ago, Raymond James put out a report on this too, and they had a list of all the big projects, oil projects that had been canceled or pushed back, and they're the same thing as IEA. They're forecasting that by the end of 2018, we could have about 5 million barrels a day less than what was expected just a year ago. Because these long-range projects, these deep offshore Gulf of Mexico projects or offshore West Africa projects, I mean, they have those slotted in and when they think they're going to come online, and these are projects that add 200,000 or 300,000 barrels a day. So when they start taking those off their chart, you see that, hey, where is the supply going to come from? And the one thing I think people really don't understand about these shale plays is, okay, like right now the companies run out and they complete a bunch of these drilled but uncompleted wells, or they're focused their drilling program on the sweet spots, like the core of the core acreage where they get the best results. Well, after you drill up the sweet spots and those wells are all in decline, you can't drill enough tier 2 acreage leases wells to make up for that decline. So there'll be this flush, and I think, we'll get, like, production today in the United States is about 9 million barrels a day. Of course, we use about 17 million barrels a day, so we're nowhere near close to being energy independent. But we're back up. We've increased about 500,000 barrels a day since about 6 or 7 months ago, and a lot of that's because of the rush to complete these drilled but uncompleted wells to get them in their year-end reserve reports. Well, those come on, and then maybe we'll get back to 9.5. That's what I predicted in my newsletter on Tuesday, and then it'll keep going. But it's not going to be like this increase in production just keeps going. It's gonna level off at some point because they just can't drill enough new wells to make up for all the decline. And there's no way. I can't see any way where the U.S. ever becomes energy independent when it comes to oil.
Yeah, I agree. Unless the U.S., like over the next couple decades, transitions away from oil to maybe some other form of power. So
it could. Yeah, that could. Yeah, if you got really, really serious about it. Let's say that we were totally cut off from imports and we had to find other alternatives. Well, then there would be a huge push to electric cars, and people wouldn't mind overpaying for electric cars. They just have to. So that would happen. It could happen, and you could switch over to running more cars on natural gas or propane or whatever. But now they're just not at today's gasoline price. That's just not cost effective. I mean, an electric car probably takes like 20 years to pay out the premium you have to pay for it now.
Yeah, I actually prefer the hybrids because you kind of get the best of both worlds compared to the electric cars. I think there's more efficiency there with the hybrids rather than just a pure electric car. But it seems, based on the oil price we have and hundreds of billions of dollars in capex cuts in the oil market, I think, deep water had the most capex cuts. It seems that at these oil prices, deep water is potentially in trouble then. So the companies where they were drastically either entirely on deep water, offshore, going after those elephant wells like BP's Macondo well or Petrobras, those companies seem to be in the most trouble because I don't think deep water can cut its costs nearly as much as the shale oil guys and the onshore ones in the U.S. and the Permian and others have been able to.
Yeah, I was down in Galveston about 6 weeks ago, and I have never seen as many rigs stacked in Galveston. There was actually 3 drill ships. These are ships that rent for like $400,000 or $500,000 a day that were just sitting there parked. And so if you got that kind of equipment parked, it's really kind of depressing out there. And I don't see that. I see no appetite for investors wanting to invest in these deep offshore projects now because the onshore. I mean, the one thing that spoiled Wall Street and spoiled investors, there's no dry holes. I mean, in these shale plays, there's no dry holes. Maybe there's some marginally economic wells that are completed, but you don't get zeros. So trying to convince people to invest in offshore drilling programs and stuff is pretty tough right now.
Now, I want to ask you about one of your main winners that you've picked out in your newsletter, Diamondback Energy. I've seen since the company listed on the exchange in late 2012, the company's up over 482%. How quickly did they get to cash flow from just an idea to get to actually drilling wells and making cash flow? And how did you find the company through your research or connections?
Well, I look for companies that have rapidly increasing cash flow, and it's quite an impressive story. I'm trying to get my forecast for it up here. Yeah, and they've financed a lot of their growth with equity offerings, which I've just been stunned that they've been able to do 5 or 6 of these equity offerings, just separated by months and issue millions and millions of shares, and it doesn't seem to hurt the share price that much. And they have 96 million shares outstanding right now, which isn't too bad. And I've still got them this year making about $9 per share operating cash flow, which is fantastic. I mean, it's trading at $100 something, but that's still just a little over 10 times cash flow. And they increased production last year by 30% in 2016. I've got them increasing production 72% this year. They are just going to flat get after it. And when you got that kind of production and proven reserve growth, that deserves a high multiple. So yeah, it's trading at a high multiple, but it's also got the growth to substantiate that. I mean, I've got a production of 107,000 barrels a day in 2018, and that's probably too low because they're going to end this year at about 95,000 barrels a day production. So, it could be a lot higher if they come out with better guidance for 2018.
It really sounds like management has done a good job, delivering, executing on the business plan, because, obviously there's a lot of companies in the resource industry, whether they're mining companies or oil and gas, that have big growth plans, and then the management just overpromises and underdelivers. There's delays, there's dry holes, like you said, the management destroys the balance sheet. So it seems that this company hasn't necessarily done that yet, and the management has, for the most part, it looks like, executed.
Yeah, it really looks good, and their well level economics are fantastic, and they've got thousands of high potential, low risk horizontal drilling locations. So yeah, your listeners should really take a look at it. Some other ones I'd mention, I really like Parsley Energy, which their symbol is PE. It's probably Diamondback from a year and a half ago, and following that same growth pattern. RSP Permian looks pretty good. Of course, Concho is bigger than this, and their growth is slow. I mean, you cannot maintain this percentage growth year after year after year. It's just almost impossible to do that. But when they're in this super growth phase, it can really send the share prices higher.
Now, these smaller independent players, are they keeping their costs better in line? Because there was a story on oil price last week when I was going to interview you, and it said that the large super oil majors, despite the oil price coming down so much since 2011, their costs have risen 66%. So that was pretty shocking to me that, these guys who have so much resources, the Royal Dutch Shells, the ExxonMobils, that they can't keep their costs in line. Maybe they've been spending way too much time and money buying back their shares with debt, at a higher share price instead of making quality acquisitions, adding reserves into the ground at a lower oil price.
Yeah, I really don't follow those super majors like Shell, Exxon, that. I don't follow them. They're just would take all my time trying to figure them out. Yeah, I'm more focused on these mid-cap, small-cap companies, but they've done a fantastic job getting their well costs down. I'm just amazed. Their drilling and completion cost, per barrel of reserve added, it's under $10. I was looking at one the other day. Your listeners might want to look at Laredo Petroleum, LPI. Their cost of adding proven reserves isn't even $5 a barrel. It's incredible. And so think about it. I mean, if you're adding proven reserves at $10 a barrel, all in drilling and completion costs, well, yeah, at $50 oil, that's still pretty darn good economics. And these wells are paying out in less than 2 years. Even at $50 oil, they pay out in 2 years. So good well level economics, better than I ever experienced when I was at Hess for 20 years ago.
Now, are these smaller companies you mentioned, are they in the Permian or in the new scoop and stack play that you've talked about in the past?
No, most of the ones I mentioned today, like Parsley, Laredo, RSP Permian, they're all Permian players. Yeah, in scoop and stack, there's really 5 publicly traded companies that control a lot of the really good acreage: Continental, Newfield, Devon, Cimarex, and Marathon. New entrants in there have been Gulfport Energy, based in Oklahoma City. That's GPOR. They're in the southern Scoop area. And Jones Energy, JONE, is a small cap that very few people have heard of. They bought a big acreage block that's kind of between scoop and stack, and they're going to be working in there. But there's the 5 companies I mentioned first. They own most of the really good acreage, especially in stack.
I want to ask you now about frac sand companies like High Crush Partners. I know you've liked that company in the past. You mentioned earlier in the interview that the demand for frac sand has grown. Is that because they're getting more efficient drilling out the wells and they're using more sand?
They're using a lot more sand. I mean, all these upstream companies that I follow are using twice as much sand per well than they used a year ago. Millions of pounds of sand. I mean, visualize this: 100 train cars full of sand are going into one well now. That's just the average well. And some of these super long laterals, these 2-mile long laterals, are maybe using 150 train cars full of sand. And what they're really doing, they're pumping so much sand into the wellbore, it's creating its own, its own zone around the wellbore that fills up. And that frac sand is really round grains, so it creates a really nice reservoir for the oil right around the wellbore, and they just they can't use enough sand. And High Crush is one, EMES is another one, Silca, SLCA is a good company, and all indications are demand for frac sand is just going to go up significantly by the end of this year. In fact, by the end of this year, demand for frac sand will probably be higher than it was at the beginning of 2014.
Now, as the oil price was experiencing a correction the last couple of years, and it briefly touched 29 a barrel, a good amount of these master limited partnership companies like Linde Energy and others went bankrupt or restructured. Do you think the MLP industry is in trouble, or do you think that was just one or two examples of a company over leveraging their balance sheet, and most of them are still in pretty good shape?
Well, the MLP model does not work well for upstream companies when you have declining prices. The reason why is they used a lot of leverage, and their balance sheets got out of compliance with their debt, and the debt holders swooped in and have basically crushed the equity in those MLPs. Now, the MLP model works very well for the midstream companies because their revenues are more fee-based, and they have much less commodity price risk. And, demand for midstream services is really, I can't see it ever going down unless you have a major decline in the U.S. economy. I mean, we need the companies that gather, process, transport via pipeline, and store these products. We need them desperately. So the midstream MLPs are fine, I think. I don't know that there's many upstream MLPs. And by upstream, I mean the guys that actually drill and produce oil and gas. And actually, the upstream MLP companies didn't do a lot of drilling. They just bought mature properties and just, produced them. Those companies they do not do well in the MLP model.
Yeah, Memorial Energy Partners, I think, was extremely hedged, and I think they barely survived. But I think they're one. I think they filed for bankruptcy. Recently?
I thought MEMP and Vanguard would survive because they had so much hedges. But what happened? It wasn't that they weren't able to service their debt. It was the fact that their balance sheets ratios went out of compliance with their debt, and the debt holders called it, and that forced them into bankruptcy.
That's very interesting. I had been paying attention to that a lot a year or two ago, and MEMP looked like they were going to make it to the finish line, and at 50 oil they were going to be good. But yeah, I guess that's surprising. I'm shocked that they got called on it.
Yeah, that's a good company too. That's terrible that happened.
Well, I guess then no one survived the upstream part. So the pipeline guys are basically like operating toll roads. So once
they are. Yeah.
So once the upfront cost of building the pipeline is expensive, but once the pipe is built, the maintenance costs are not that much, and the cash flow is pretty good. So
that's right. Yeah, that's right.
Well,
and the cash flow just maintains. And I like the MLPs that are tied to these really good producers, like Devon spun off EnLink. It's a really good one. So Devon's going to have a very aggressive drilling program, and most of their production ends up going through the EnLink system. Antero Midstream, AM is that symbol, and Antero has just got a tremendous growth. Antero Resources, the upstream company, has tremendous growth that's going to run through the Antero Midstream system.
Yeah, so thank you for those names. I want to transition now and ask you about natural gas the rest of the interview. Here in DC, Northern Virginia area, we haven't had a lot of snow. It's kind of been a more mild winter. It's been cold, but not as harsh a winter as we expected. So do you think the natural gas market has suffered a little bit because of the weather here?
Well, yeah, it's suffered a little bit, but I think investors pay too much attention to the weather-related demand. Weather-related demand is probably the third largest part of the demand and really the difference in demand between a cold winter and a warm winter isn't really that much. And the gas in storage is going to probably end up 300 or 400 billion cubic feet below where last winter ended at the end of March. So we'll have that to refill. But industrial demand, exports, and gas used for power generation are supposed to go up 3.5 billion cubic feet a day this year. Well, you got that. You probably got refill another BCF to 2 BCF more demand. and then you got production decline. U.S. gas production has declined 2 BCF a day from year to year. From the second half of 2015 to the second half of 2016, it's declined 2 BCF a day. So we've got a much tighter gas market, than people realize. And I think it'll come, ironically, it'll show up more this summer than it did in the winter, because the mild February really masked the situation. I mean, if you go back to December, you will see that we were having big draws from storage because we were having a regular winter weather in December. Well, then it kind of got a little milder in February and March, and very mild, in fact, record warmth in February has masked the tightness of the gas market, and you'll see it show up again. You'll see it show up this summer. Believe me, we're going to have a much, much tighter gas market. And one thing people aren't really talking about much is the NGL market. NGLs with natural gas liquids, this is butane, propane, ethane. Natural gas prices from the third quarter to the fourth quarter increased an average of 30%, and it's hardly even talked about. And these upstream companies produce a lot of NGLs, and very few of them are hedged.
Now, I know Cheniere Energy is supposed to start exporting natural gas. I know there's been investments into other LNG export facilities in the United States. I'm not sure about the timeline when the other ones are supposed to come online. Are there other facilities coming online besides just Cheniere Energy's one?
Well, Cheniere Energy is already online. They've been online for almost a year. They're exporting like 2 BCF a day out of Louisiana. They have a second train coming online here pretty soon, and then there's this out of Freeport, another one's coming online. But by 2020, we will be exporting about 9 BCF a day as liquefied natural gas. Also, the surprising thing to me this year has been a huge spike in exports via pipeline to Mexico. Mexico is very dependent on gas for their power generation down there, and we had one of our luncheons. We had the last Texas Railroad Commission chairman spoke at our luncheon. He thought that exports to Mexico would get up to like 7 billion cubic feet a day. There's several big pipelines running from the Permian and the Eagle Ford now into Mexico.
I don't know if you've been paying attention to this, but Mexico's been having big tax declines from Pemex lately, and that's because, they're getting big depletion numbers from the Cantarell field. So, they've been having trouble getting the production back up on that. Their tax revenues are down from that as well. So I'm not surprised that they're importing, natural gas for their own energy needs to make up for that.
Yeah. They're becoming very dependent on West Texas gas.
And there's also a lot of, shale oil potential across that border there from the geology, from what is it? Not the Permian field, the Eagle Ford shale. Yeah, the Eagle Ford shale right across the border.
And the Permian stretch out into Mexico probably, but more the Eagle Ford. There's a lot of Eagle Ford gas that's right across the border in Mexico, but nobody's drilling down there because those states are controlled by the cartels. I mean, you're never going to get onshore drilling companies allowing their equipment and people to go down into Mexico. I mean, it's really kind of funny if you go down into West Texas, there's all these rigs drilling on the Texas side of the border, and there's none drilling on the Mexico side of the border, and the geology goes across the river, so it's sitting there.
Yeah, I've seen a night map of that where someone with a satellite took an overhead picture at night and showed the drilling rigs at night, and they marked the Mexico-Texas border, and, it's complete. There's no lights at all on the Mexico side, no drilling rigs or anything.
Drilling, nothing at all, yeah.
Do you think then that the natural gas production, obviously there's a lot of shale gas as a byproduct in these shale oil wells, but I guess a lot of the primary shale gas companies shut down production then?
No, the Marcellus Utica play is, in fact, I follow several companies in there that I think are great buys right now, but that's coming online now with more midstream companies so that they can get their gas out. Last summer, there was big differentials in there because there wasn't enough takeaway capacity, and so they were all bidding for the limited takeaway capacity. But there's more pipelines coming out of that area now that'll be able to get that gas to the south. The one you ought to look at, if people want to learn more about the overall gas industry in the United States, just look at EOG Resources, which is kind of my top gas pick, symbol RRC, and they've got a lot of information on their website about how just the U.S. gas market works. These exports to Mexico are also helping take some of that Texas gas south into Mexico and west, and so it's not clogging up the system like at the Henry Hub, which is Henry Hub, Louisiana, is where the NYMEX futures contracts are settled. And so that's not flooding that hub now, so that's helping balance the market too. So there's been a lot of changes recently in the gas market that's going to get better prices for everybody, I think.
Now, SM Energy, they're a primary natural gas producer. I think you've liked them a lot in the past. Do you still think I think they were earning over $9 a share in cash flow, right? So very cash-rich company.
It's kind of come down. They sold off a lot of their Eagle Ford stuff. They're really a company in transition right now, which will probably keep the share price down a little bit. But they have sold off their non-operated Eagle Ford stuff. They were in a joint venture with Anadarko, and they sold that off, which tremendously improved their balance sheet. And then they've used some of that cash to get into the Delaware Basin and the Permian Basin. Actually, I correct myself. They're more on the Midland side. They're on the Midland Basin side of the Permian, and they've got about 90,000 acres in there that looks really good. In fact, they're drilling a lot in the same areas where like Diamondback and these other guys are now.
Do you expect then the U.S. Natural gas demand to increase at a faster rate than oil demand globally then going forward?
I don't know if faster. I mean, the U.S. gas market is a closed market. We have very little import capacity other than pipelines from Canada, and Canadian production is down too. So we'll be a net exporter here in a couple of years, but we've lost our ability to import by LNG because we switched all of our import facilities to export facilities because we got so much gas. But we're totally independent when it comes to natural gas. But the demand's going to be going up about 3.5 to 4 BCF a day per year, regardless of the weather. So that's just going to happen, and we'll probably be 100 BCF a day market by 2020. We're about an 85 BCF a day, 87 BCF a day market right now.
I still see a long-term demand for natural gas and both oil, globally when you're talking about demand growth out of Asia, demand growth out of Africa, demand growth out of South America. I still see big growth potential there, although, in the short term, the global economy, things may deteriorate in the short term, but I still see, people who don't have electricity right now, who maybe don't have a scooter yet or a car yet, they want to go out and buy them and they want to make their lives easier and more efficient.
Right, and China's really got pollution problems, so they really need to switch from coal-fired power plants to gas-fired power plants. So that's going to help demand also.
Excellent. Well, I enjoyed reading your newsletters, and you definitely do have a track record here of winning stock picks. Even when the oil price didn't go up that much, you were still producing winning income plays and also growth plays like Diamondback Energy that went up a lot despite, the oil price not really going up that much. So I think, you can proven that you've picked out winners even when the commodity price itself isn't screaming higher.
Yeah, thanks.
Well, if our listeners want to try out your newsletter or maybe attend one of your luncheons down in Dallas or Houston, how did they do so?
Well, you can just check our website. It's energyprospectus.com. And if they send an email to just energyprospectus@gmail.com, just tell them to send it to me and tell me that they heard about it on your show, and I'll give them a $100 discount off our subscription price.
Excellent. I'm sure people will take you up on that because we do have a lot of good resource investors who listen to this podcast.
Okay. All right. And I'll send them a free newsletter. We just published one on Tuesday.
Okay. Well, I look forward to speaking to you again, Dan, soon about the oil and natural gas markets. We're in very interesting times here with Trump running things. So we'll see what he's able to accomplish.
All right. Thanks a lot.
Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations if you go to the wallstreetformainstreet.com website. We accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin, through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mailed donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.